Welcome back to Finance News, the only show you need for all of the week's best stories from the stock market, investing, and business. Whether it's big tech in the US or your favourite FTSE 100 stalwarts, we've got you covered. It's been another big week of stories, so let's get straight into your headlines. It was a crazy week for big tech earnings last week. The market awaited the news from some of the largest companies in the world to see if we were actually headed into any kind of a downturn. Google's parent company Alphabet posted their Q4 results and mostly beat Wall Street expectations across the board. Revenue came in at a whopping $75.3 billion against expectations of $72.1 billion, and earnings per share also beat, coming in at $30.69 against the expected number of $27.14. The only miss came from traffic acquisition costs, which was slightly higher than predicted, meaning that the company had to spend more money than they would have liked to ensure that your eyeballs remain glued to their products. To put these numbers into perspective, the largest company on the FTSE 100 here in the UK is currently Shell, the oil producer whose entire 2020 revenue came in at $180 billion, and even they lost money last year. Ouch. Adding to their incredible results, Google also announced a share split of 20-1, which will take place on Friday, July 15th later this year. This means that for every share someone currently owns, they will receive 20. There's no change in the underlying value of the company, but it will mean that it becomes cheaper to own a share in the previously costly company, which will likely lead to more ownership by retail traders who currently have to pay $2,865 for one share of the business. In other big tech earnings, Facebook, now rebranded as Meta, had a bit of a car crash of results from their final quarter of last year. Shares fell more than 26% last week in a single day of trading, wiping off a record $230 billion of value, the largest amount ever seen from a US company in all history. The reaction on the markets came from the company's first ever drop in numbers of daily active users on the platform, and from the additional expenses that have been adding up as the company transitions into the big bad world of the metaverse. Nobody quite yet knows what the metaverse is or is going to be, but we do know that it costs a hell of a lot of money and investors don't like big expenses without the profits to go along with it. I will say though that virtual reality is a lot of fun, so as far as I'm concerned, they can keep losing money if I can keep shooting virtual zombies. It's a great stress reliever. Look, stand back, I'm going to shoot you. Mark, why are you wearing that outfit again? No. Staying with other social media giants, Snap, the company who publishes the popular app that allows users to send pictures and videos which expire after certain timeframes, actually posted results showing a profit for the first time. Yes, actual profit, real net income for the first time in the company's history. Shares of the company rallied nearly 50% after hours on Thursday, although they had plummeted after hours on Wednesday more than 20%, so don't get too excited. The company managed to increase their daily active user count by 22% compared to the year before, giving investors the green light to go ahead and pump the stock. Don't worry if you've never heard of the company before or not used the app, it just means you aren't down with the kids. So that includes me. In Tesla news this week, news stories from mainstream media attempted to spin a story about a vehicle recall of nearly 54,000 vehicles. The electric car maker, who is currently rolling out advanced self-driving capabilities to select customers in the US, as we reported last week, is having to make a software update to reverse some changes in order to prevent violations of local laws. The current software allows the car to drive through a four-way stop intersection if there are no cars or people around. However, technically, the car should come to a full stop as required by law. The update and change will be provided through the company's over-the-air update system, which will correct the software without any intervention by the drivers or having to bring a car into any dealership for service. Only other recent real recall outside of software came from Tesla having to recently recall several 100,000 vehicles because of a potential rear camera harness assembly being damaged by the trunk lid back in December of last year. Clearly, some news outlets just like to cause hysteria and still don't understand the difference between a software update and a hardware change. Bless them. Now let's shoot back to the news closer to home. The Bank of England has announced an interest rate rise to put the base rate to 0.5%, which is a doubling from 0.25%, where it's been since late 2021. The move comes in as the UK faces record levels of inflation, just like the US, from wildly expensive costs of fuel, rising costs of food too. UK households are expected to take a huge hit come the new financial year, as the energy price cap was lifted by 54% to a huge £1,971 by the regulator Ofgem. To counter this, the Chancellor Rishi Sunak announced a strange package of buy now pay later, where council tax and energy bills will be discounted for most properties, but then paid back in £40 instalments in future years. The plan involves giving people a £150 council tax rebate, which will not have to be paid back, coming into force in April for all households in bands A to D. And secondly, households will get a rebate of £200 on energy bills from October, but this will need to be repaid in £40 instalments over the next 5 years. Yay! Updating MPs, Mr. Sunak said it was
This year, all domestic electricity customers will receive an upfront discount on their bills worth £200. Energy suppliers will apply the discount on people's bills from October, with the government meeting the cost in full.
If all of that news is making you sad and feel down as we start the working week, don't worry, because this is where I give you a good news story of the week, which will fill your heart with optimism and give you the drive you need to power forward. Okay, that might be a bit too optimistic, but here goes anyway. CNN reported that a slot machine winner who visited Las Vegas had to be tracked down after a machine malfunctioned to get their prize. The report says that a tourist out of state visited the Treasure Island Hotel and Casino on the 8th of January, where they ended up winning a jackpot on a slot machine. However, the malfunction did not make it obvious to the player, so they ended up walking away. Now, due to the strict rules enforced by the Nevada Gaming Control Board, the player had to be tracked down and given their prize, as it was too late by the time the officials had noticed the error. With hours of work trawling through CCTV, receipts and even rideshare data, the winner was identified and tracked down to the nearby state of Arizona and was finally awarded their $230,000 award. The winner was announced as Robert Taylor, but he will have to go back to the casino and collect his prize. I'll have to follow up on this story if he ends up gambling the winnings back again. I really hope this doesn't end up like a scene from The Hangover.
Hey guys, you ready to let the dogs out?
What? Do what?
Let the dogs out, you know, like, who let the dogs out? Who brought this guy along?
Off that bombshell, let's see if there's been any new companies hitting the streets this week in IPOs of the week. Ooh, IPOs of the week. I wouldn't be doing that in public. This week has seen yet another set of random special acquisition companies. You'll see these on the IPO calendar and they're all the rage at the moment for investors. The purpose of a special acquisition company, or a SPAC as they're cleverly referred to, is to acquire companies to take them public without the company having to directly list on the market itself. SPACs have 2 years to make their play, otherwise their funds from investors have to be returned. The popularity of SPACs have soared over the last few years as a way of taking companies to market and injecting large amounts of cash into a company, with the investors in the SPAC getting a healthy cut of the business or preferred stock awards. However, returns from SPACs may be well below expectations when the initial hype has worn off. That's according to Goldman Sachs. They say, of the 172 SPACs that closed a deal in 2020, the median had outperformed the Russell 3000 index from their IPO, but 6 months after, the performance was lacking by 42 points against the same index. Be careful out there, guys. I'd probably stay away if I were you. Now, time to look at some of the more unfortunate events that have happened in the markets this week. Just when you think it couldn't get any worse, fails of the week. The Home Secretary has approved a ruling that British tech billionaire Mike Lynch should be extradited to the US to face criminal fraud charges over the sale of his software company Autonomy to Hewlett-Packard back in 2011. A spokesperson for the UK Home Office said that on January the 28th, following consideration by the courts, the extradition of Michael Lynch to the US was ordered. The 17 charges have been brought after the US accuses Mr. Lynch of propping up the share price of the company, which was sold to HP for $11 billion, which ended up in a huge write-down for the company as they claimed that financial statements were falsified, income produced dishonestly, and orders recorded for the benefit of the company without fairly reflecting the true value of company business. Former CFO Sushifan Hussain is currently serving a jail sentence of 5 years. The tech entrepreneur eventually went on to be the major founding investor in UK cybersecurity firm Darktrace, which has been brought into the controversy and arguably may have never been created without the proceeds from the sale of Autonomy. Do you guys remember when Autonomy used to sponsor Tottenham Hotspur back in 2010? Yeah, that's the same companies we're talking about today. Just shows how slow the justice system is. Anyway, watch this space. I'll keep you all updated with any changes as things hot up in the legal wranglings from the UK and the US. Finally then, let's go to your favourite section where we poke fun at the world of investing and remind ourselves that we're all just over-evolved apes. Let's go. Welcome to the best of the bets. Sometimes you've just got to see the lighter side of life and make sure you laugh at the stock prices. Otherwise, you'll end up crying. If it bleeds, we can kill it. Sorry, Facebook. I'm sure plenty of people will buy the dip though, right? In more poking fun at Meta, this Reddit user reminds us just how hench Jeff Bezos is now. He's gained some extra muscle with his latest Amazon earnings. The best comment on this thread calls the Amazon founder an Amazon Basics Vin Diesel. I couldn't have wrote anything better, sorry. In probably one of the most degenerate and traumatic screenshots I've ever seen, this user shows us their Robinhood brokerage account, which he says went from $10,000 to 1.6 million, but then all the way back down to 200,000. I guess you can still spin that as a win from 10k to 200k right as you wipe away all of those salty tears. I really hope he takes some money out soon. Remember that sometimes diamond hands give you diamond losses. As tech stocks got sold off over the past few weeks, a reminder to us that investors can get bored of their stocks when they don't perform. I thought that stocks were meant to 5x in a short period of time, and that's what investing is, right? Anyway, on to the next hype stock. Or how about we all just buy some NFTs? Sorry Meta, Apple just has to have the last laugh. I still have a feeling that Zuckerberg will be just fine. Worst case, he can always find some way to hide in the metaverse and only come out for dinner time. In fact, I'll probably do the same soon when I look at some of my losing investments. No, I'm not hungry. I'll come down for dinner later. Go away. Mum, close the door. Anyway, that's all we have time for. Thanks for watching this week. See you all in a week's time for some more fun. Drop me a like if you've enjoyed the video. Subscribe for many more. I'll see you in the next one. For now though, and as always, happy investing.